Hey, welcome to Roger That, where we want you not to just have a great retirement, we want you to have a great life. So today we're going to answer a question, and I think it's an important one if you're looking at financial advisors. And it comes from Tom, and he wants to know two things. Is always using a fiduciary advisor the best thing, like he's heard? And two, why doesn't anybody talk a little bit more transparently about what advisors cost and what you're getting for that? So let's take those two things. So let's tackle this fiduciary question to begin with. Tom says that he's listened to Rick Edelman, a huge financial advisor, rant for years on his podcast about how you're pretty silly if you don't use a fiduciary advisor. And Tom sort of questions that. He says, wait a second, if I use someone that is just selling me something and they get a commission, that could be long-term a lot less expensive than using a quote-unquote fiduciary advisor that charges their fee every single year. So that's actually a very good point, Tom. So let's discuss how you would make that determination. So think of if you're going to buy a car and you go into a car dealership and you meet the car salesman who is working as a commissioned broker to sell you the car. They're going to earn a commission only if you make a transaction. You probably don't want to rely on them to help you do all your research and select the car that's right for you, because they are incentivized to get you to buy maybe the most expensive car, and legally they're not acting in your best interest. They're acting in their own best interest as a commissioned salesperson. There's nothing wrong with that, but you have to do more of the research and use them to help navigate the different selections, but not let them give you advice on what you should actually do. Now, I think that's a good scenario. So if you are just simply looking for an investment strategy or a product and you do your own due diligence, you can use a commissioned salesperson to help you understand the different trade-offs, but you probably don't want to take advice from them because they don't have your best interest as their first fidelity, right? And where it can get confusing for a lot of us that are looking for financial advisors is commissioned salespeople call themselves financial advisors. So they're going to walk and talk and be labeled as someone that gives advice, but legally, they actually only have to suggest or recommend something appropriate, not necessarily in your best interest, which is a very different standard that you may not know on your own end. So I think when Rick Edelman talks about hire a fiduciary, he's talking about you want someone that's legally obligated to work in your best interest. Now, if you're only looking for a product and you're doing all your due diligence, then yeah, a commissioned salesperson may be able to help you and you may save money because you're doing more of the heavy lifting yourself. So I think that's one big important distinction. Now Tom goes to, well, I don't believe I've heard you ever discuss the fee structure we should be expecting from a financial advisor, and we'll assume that's a fiduciary advisor. And I've listened to other financial podcasts, and you aren't the only one who seems to shy away from discussing this topic. I've heard in most cases they charge a fee based on the assets that they're managing, and that fee happens every year. And then he says, well, should that fee be less if it's a less aggressive portfolio, say a bond portfolio? So first off, Tom, I think the term shy away sort of sounds like somebody's trying to hide and get away from something, and that's not the case, but it is a very important question. So let's talk about this. First, I want to talk about, should the fees be less if you're less aggressive? And I think that comes from a very investment-centric focus. So as an example, from the Investment Fact Book 2017 shows that the average equity or stock mutual fund had an expense ratio of 82 basis points, which is a little less than 1%. And the bond average for a mutual fund in 2016 was 0.58% a year, or a little over 0.5%. So yeah, if you're less aggressive, typically you'll see less fees because there's less moving parts and things that you have to pay attention to. But we're just talking about investments, right? So if you are hiring an advisor only to build the investment portfolio, then that is a valid question. Personally, I think outside of the ongoing advice, if simply you want an asset allocation, you just want an investment portfolio and you don't want more comprehensive advice, it's probably not a good idea to hire an advisor. If that's only what you're looking for, unless you're looking for an eclectic custom portfolio that is actively being managed. I think in this day and age, if you just need asset allocation, you don't need to hire an advisor for that. So the question is, well, why do you hire an advisor? What value can they add? Well, outside of just simply the investment selection and execution part of it, there are a lot of potential values that an advisor can add if they have a very well-defined process. So Vanguard, over the last decade, has done a study called Advisor Alpha, where they try to be very scientific in identifying how much value could an advisor really add. So I got some of the results here, and you can find it if you Google Vanguard's Advisor Alpha study. Google that, and we'll have a link to it in the show notes here. So they identified a number of different areas where an advisor could potentially add value. And again, I think the big premise here is that the advisor actually has a very well-defined process that they follow religiously. Oh, side note, we did a whole discussion on this on episode 204 from the Retirement Answer Man podcast, and you can find it on iTunes, and we'll have a link to it below if you want to hear some examples and a little bit more in-depth discussion. But let's go over real quick where an advisor could add value, assuming they have a good process. One is cost-effective implementation expenses. That's a very low-hanging fruit. And Vanguard estimated that an advisor has the potential of adding about 40 basis points in returns per year by being very cost-effective in how they actually implement the portfolio. Rebalancing, which means keeping a target allocation close to the target year after year as assets move around. So you're never varying too much from your risk-reward profile that you've decided you wanted to have. Vanguard says a good advisor could add about 35 basis points, or a little over 1/3% a year, if they have a very well thought out rebalancing policy. Now, here's the big one that Vanguard found, and I would agree with this when it comes to investment management only, and that is behavioral coaching. Vanguard says that a good advisor could add as much as 1.5% a year just by helping people not make poor investment decisions when they get too greedy, when they get too fearful, when they hear a great idea. There's that movie Up where there's this dog and he always goes, squirrel. It's very easy to get distracted with 24/7 news and all our friends talking about investments to start to do different investment options because they seem cool at the time. So I think a lot of the value an advisor has, if they have a good process, is helping stay the course in a well thought out plan rather than being sloshed around in the sea of the current news cycle. Now, asset location, they say they could add up to 75 basis points, or 0.75% a year in returns. And so asset location means deciding, okay, where do I hold certain asset classes? Do I keep my bonds in all of my accounts, or do I just have them in my tax-deferred accounts or in my taxable accounts? There are decisions that can have an impact on performance. And then they say spending strategy, meaning, okay, if you're taking money out, this is one that's a big one for us, talking about retirement, is where do I draw money from in the most efficient manner? And they say that an advisor could add a little over 1% a year in returns just through that. So if you want to check out that whole study, you'll have a link to it below, and it's called Vanguard's Advisor Alpha study. And they say the total potential value a good advisor could add is about 3% a year. Now, I don't know if that's true or not. They tried to put some quantifiable numbers to it. I think there are a lot of valid points in those areas where a good advisor could add value. Here's an interesting thing, though. One, it assumes that an advisor has a very well thought out process that they stick to. And it also is still focused only on investment management, right? So outside of asset selection and just going for the easy button, one reason maybe to hire an advisor would be for all of these other behavioral things around investment management. And that's where I think the real value is, because it's more holistic than just simply focused on the investing part of our solution, which is really where most advisors focus. And here's a sidebar. Why is that? It's because that's what they're trained in. So I went through the training program years ago with one of the largest financial institutions in the world. And all of the training focused on investment product knowledge and sales presentations. So that's one reason why everybody is just focused on investments. And as important as they are, there's so much more to creating a great retirement and a great life. So what are some things that an excellent advisor could add value to? Well, we've created a retirement standard of care that we're excited that we're just rolling out. So I'm just going to tell you some of the big rocks in that. So you have, what kind of life are you trying to live? That goal identification of those needs, wants, and wishes, not just early retirement, but late in retirement. So, flushing out what those things are so you can create the kind of life you want once you reach that age. And then the second big rock is cash flow. Okay, what income sources do we have? That's Social Security, pensions, inheritances, pre-retirement income. And where are the risks and opportunities within that arena? A good advisor is going to help identify those risks and opportunities and take action on those. The third big rock is your net worth statement, not just your investment assets, your net worth statement, which is all of your assets and all of your liabilities. And within the framework of what kind of life you're trying to create, helping you make decisions on how much emergency fund should you have? Where should I draw assets from first? Where should I deploy inflows of assets like income and inheritances? And then how should it be from a tax structure in terms of tax deferred, after tax and Roth, tax-free type of assets? And can I afford to buy the house? Can I afford to go on these trips? Deploying your entire financial net worth to work towards the goals that you want. The fourth big rock is the risk management end of it is, okay, what risks do we have between now and the end of our life? Let's try to quantify those in the context of what we have as resources and decide how much we try to mitigate those through life insurance and things like that. And then lastly, and this is the one that almost nobody talks about, is when you're transitioning into retirement, there are a lot of qualitative things that we don't think about. One is, how do we invest in our health proactively? Because that has a huge financial impact on how everything's going to work. And a lot of us don't think intentionally about that. How do we invest in relationships now that we're moving away from a work environment to where sometimes we leave all of our friends? How do we invest in our marriage? How do we invest in creating a robust network of friends to really hit on the quality of life? And then lastly, how do we find a purpose for us to get up in the morning? Because we are meant to have a purpose and be striving for something. And that could be simply going fishing every day. It could be lots of things. But when you transition into retirement, it's important to have some type of purpose that drives you. Study after study shows that's when we are the happiest. And that's when they're most proactive. So then the question becomes, what should an advisor charge? So on average, advisor fees, meaning a fiduciary advisor, can range anywhere from 2.5% down to 1 to even below that, depending on the assets you have. But what I found is almost all financial advisors focus on the investment paradigm in all the areas that Vanguard says there might be some value to be had, and not the total life management in dealing with the transition. That doesn't mean it's not worth it, but I find most advisors are almost all focused on investment management and not helping with really the levers where you have the most control over and the most opportunity to make a difference in your life, which are not necessarily just investments. But there are a number of advisors, I count myself as one of them, that charge normal to below normal fees. And I think our fees start at 1% of the assets that we manage and go downwards. And we work as a fiduciary advisor, where we're encompassing everything together. So I think, Tom, the question is, if you're just looking for a product and you need a guide, a commission person may be the best thing. If you're looking for someone to help give you advice where they're legally obligated to serve in your best interest, a fiduciary advisor can be a great option. Then the question becomes, what are you hiring them for? If it's simply investment management, maybe the fee should be lower than average. If it's life management, including investment management, you're going to have to decide for yourself what makes the most sense for you. Now, we are going to have links to the Vanguard Alpha Study, links to the episode where we dive into this in a little bit different with some examples. I would love to hear your comments on what is the value that an advisor brings to you. We also will have a link for if you're interviewing advisors or if you're evaluating your advisor, a framework of the questions you should be asking your advisor. That should be a whole nother video, and maybe we'll do that. So, hey, until next week, if you enjoy this video and you want to hear more of it, subscribe, I think it's this direction, to the YouTube channel, where every week we'll be helping you not just create a great retirement, but hopefully a great life. Till next week, Roger, good to see you.